Hello and thank you for joining us today. My name is Wesley Boudreaux, one of the financial advisors here at the Retirement Group. Today we're going to go through a topic that a lot of you have been asking us about, and that's really the question on my pension. Should I take the annuity or the lump sum? And as always, there's not a one-size-fits-all answer, but we'll go through some of the different pros and cons and hopefully educate you on those different choices. Before I get started, just a quick reminder, even though we've worked extensively with a lot of different companies, that does not mean we're endorsed by nor employed by your company. But chances are we've done a lot of work with you and we do understand your company plan, so we can walk you through this process pretty clearly and help you decide the best option. And obviously tying that with the cash flow analysis is one of the best ways. Now, throughout the course of this webinar, there's going to be a couple of things to keep an eye on. There is a Q&A box, so we'll try and get to as many of those questions as we can at the end of this. If you do have a question, go ahead and put that in there. Your name will not be displayed, so it is anonymous, and we'll try and get to that at the end. If we don't, we'll try and follow up with you, hopefully. And then there is a chat box, so if, we'll be putting some information here periodically on different things like how to follow along with us on LinkedIn if you want to get updated specifically on your company plans, maybe a spot to schedule an appointment with myself or one of the other advisors in the office. Also, maybe a survey in there letting you know, or you letting us know how the webinar went or any new topics you'd like to add, different things like that. So just keep an eye on that chat box as well. So before I get started, just a quick reminder for those of you who do not know who the Retirement Group is. We are an independent financial advisory firm that focuses on working with corporate employees and helping them transition into retirement. And we've been doing this for about 30 years, a little bit over that, working with about maybe 20 some odd different companies. And the reason we work with select companies, it gives our advisors a better, deeper understanding of your benefits plans inside and out. So whether it be your 401k, your pension plan, your healthcare, retiree, medical, life insurance, all those different options, we can help you with that transition process from an employee to a retiree and make sure you maximize the company benefits, so when you do walk out the door, you get as much as you can from the company, which in turn will set you off a little bit better in that retirement picture as well. Now, we do have offices throughout the country, so rest assured if you need to sit down with somebody face-to-face, we can probably still accommodate that, but obviously this day and age, we can do web meetings, phone calls, emails, whatever your preferred communication is, just let us know. And I mentioned it before, but at the end of the day, if there's anything you take us up on, it's our complimentary cash flow analysis. This is essentially a detailed financial plan specific to you and your company benefits, so we can help you determine the best day to retire to maximize those benefits, as I mentioned before. Now, you might come to us and have a specific date in mind or a specific age in mind, and we can run that number. But we can also look at variations as far as whether you want to take the pension as an annuity or a lump sum, which we'll go through some of those here today. Whether you want to retire earlier and see if that could be something that could work out. But we're also not going to shy away from telling you, hey, look, unfortunately, if you want to spend this amount of money, you can't retire at this date. You need to work another 2 or 3 years. So we will run that and be honest with you on the different outcomes. And we look at this from a pretty conservative standpoint. So we're not pessimistic, but we're conservative. We don't want to be too optimistic on things and make a mistake on those planning procedures as well. And all of this helps you determine the best day to retire, the best options on the pension if you have one, and then in turn what the best investment strategy would be. We can put that together for you as well. So the different choices that we see, again, this is only going to be if you've got a pension plan within your company-sponsored plans, and a lot of the companies we work with still do have pension plans. Now, a lot of those are going away or making changes to them. So again, on a one-on-one basis, if you have a question on your company plan, let us know. And what I'm going to go through today is going to be kind of more in line with the classic defined benefit plan, in which case there's a formula used to determine what your single life annuity is going to be. There are other plans like a cash balance plan, which has been more popular over the last decade or two, because not popular necessarily for employees, but popular for employers, because it allows them to know exactly what they're contributing on an annual basis like they do in the 401k plan, and don't have to worry about being on the hook for paying an annuity out for the rest of your life. There are options to take that cash balance and convert it to an annuity, but again, if you have questions, we can go through that. And honestly, for some of the companies we work with, some individuals have a split. They have a defined benefit plan with the classic calculation, and they have a cash balance plan, so it gets more complicated. So again, this webinar is going to be more broad-based, and just give us a call to go into detail. So again, the defined benefit plan usually is going to be a formula that looks at your years of service, your final average pay, and a specific multiplier and Social Security offset to come out with what is your single life annuity. From that point, everything else is calculated off of that. So a single life annuity is pretty simple. You run that calculation, let's assume maybe you're going to get $3,000 a month for the rest of your life. No more, no less, no cost of living adjustment usually within these like you see in Social Security. So if you retire and you get $3,000 a month for the rest of your life, that's what you're going to get now and in 10, 20, 30 years. So again, you do have some erosion of purchasing power based upon inflation there. Then you go into the joint survivor. Then we're going to focus on interest rates, and we'll also talk about lump sum options. Now, I went over kind of a bit on the single life annuity before this slide came up, but again, that's that fixed amount for the rest of your life. One of the things to be aware of, again, is inflationary pressure, and then obviously longevity. If you think you're going to live a long time, then that annuity is going to pay out pretty well. But if you think there's health risk to you personally or maybe your family, where you might not live as long, then the annuity may not be the right choice for you. It may be the lump sum. We'll go through some of those options here a little bit later. Now, if you want to make sure that you're taking care of not just yourself, but maybe a spouse or a significant other, then that's where you look at a joint survivor annuity, which pretty much every pension plan gives you this option. Now, the way that they give it is may deviate from plan to plan. Maybe you get 100% continuation, 75, 50, 25%. Maybe you have all those choices, maybe only one choice. What that means is, in that example I gave you before, let's assume that single life is $3,000 a month. If you're looking at adding your spouse or significant other, then it may not be $3,000 a month because now the company has to pay out over 2 lives. So there's more risk of one of you living longer, and it costs the company more. So instead of $3,000, it might be $2,500 a month or $2,600 a month. It all depends upon the calculation based upon your ages when you go through that. Now we do have on here a pop-up provision. This is not every company doesn't have this, but some do. And what that means is, excuse me, is let's say, you name you and your spouse, and God forbid something happens to he or she early on in retirement. Let's say you set up a joint annuity that's going to pay you $2,500 a month instead of $3,000, and maybe your spouse passes away in the second year. Then what will happen is if that happens within the first 5 years, you get to step back into that original $3,000. So again, so it's a unique feature for some companies, but not all. So again, when you give us a call and we go through your cash flow analysis, we'll be able to tell you one-on-one what your specific options are in that process. Now the other option, if you say, hey, I don't want the annuity, and before I get in, there's also the ability to add what's called a period certain on there. So that way, if you want to make sure that either you or your beneficiaries are paid out for a certain amount of time, you might be able to add a 5, 10, 15, or 20-year period certain. So that way, if you, let's say, pass away in the 15th year, there's 5 more years left that goes out to your beneficiaries. That's another option you may see as well. But what a lot of people are asking us about now and have been for the last couple of years is going to be the lump sum option. Whereas the last few years, thanks to the pandemic, it drove down interest rates, which drove up lump sums. So we saw, I'd probably say 90% plus people taking the lump sum. Now the interest rates have changed. That may be a little bit different. So if we take a look at the seesaw pattern here, it's good to keep in mind in reference so that you know when interest rates change, the inverse happens to your lump sum. If your company gives you lump sum, not every company does give you lump sum options, but some do. So what happens is when interest rates go down, your lump sum is going to come up, which is what we saw during the pandemic. The government drove down interest rates quite a bit, which in turn drove up lump sums. Now the flip side has happened as interest rates, actually move up, it's going to drop your lump sum. We saw those rise quite a bit in 2022 and very quickly. So what we saw is a lot of these higher lump sums come down because those interest rates went up quite a bit. Now the good news is since October, we've seen this kind of level off and start to come down slightly. We'll see as time tells if they continue to move down and how that could affect those lump sum calculations for anybody looking to retire in the next year or two. Now again, the interest rates are different from company to company, but I'd say the bulk of them use what's called the PPA segment rates, the Pension Protection Act segment rates. Now these are 3 different segment rates based upon 3 different times of retirement. First segment is going to cover the first 5 years of retirement. Second segment is going to be years 6 through 20. And the third segment is going to be years 21 and beyond. So for most of us, that second segment is going to have the highest weighting since it covers 15 years of retirement. Now these are updated on a monthly basis from the Fed, and depending upon your plan, they may or may not update those on a monthly basis. Some companies update their interest rates monthly, some do it once a quarter, and some do it once a year. So it's important to give us a call to kind of get a better idea of what your specific company plan is. Because as those change, it could change the dates as far as when you want to retire. So a good example would be right now. Last year, people wanted to get out before the interest rates moved up and cost them money. This year, it may be that you might want to retire, but maybe defer your pension as interest rates move down. It could increase your lump sum over the coming months or coming quarters or the next year. And there's also another factor to put in there, depending upon how old you are. Some different companies have age penalties, meaning if you retire before a certain threshold, that maybe be 60 or 65, you don't get all of your pension. So you might, for instance, retire right now, and maybe you're 59 years old. You're 1 year shy of 100% pension at age 60, plus interest rates are going down. So we might tell you, hey, you might want to hold on to this and defer this out a little bit. But until we run that cash flow analysis or talk to you one-on-one, we won't be able to tell you specifically. But it's really important to let us know, because these are items where we've seen people and other advisors make mistakes and cost their clients, $10, $20, $30, $40, $50,000 just by making the wrong decision on the pension plan as well. And if we look at these rates, this kind of gives you an idea. So right now for January, we're at 4.74% for the first segment, second segment 4.98, and the third segment 4.84. If we go back, you see September, actually October was we kind of hit that high point of the second segment at 5.83. We don't have a chart going back here, but if we go back a year or two, we actually go all the way down to the 2% range, 2.25 range or so for that. So again, we've seen interest rates jump up quite a bit. We'll see where they go from here. Now, that lump sum option, like I mentioned, I've kind of gone through this when I talked about the interest rates, but the way they actually do it is they take a look at your annuity. So let's assume you get that single life annuity in that example I gave you before of $3,000 a month for the rest of your life. Let's assume maybe you're 60 years old and they look at longevity tables, which is maybe 86. So that means they say, okay, we know we're on the hook for paying this person 26 more years. Obviously, you might pass away before 86 or live longer, but they have to use the actuarial tables. They say, okay, if we have to pay you for 26 more years, $3,000 a month, what's the current interest rate? And then we'll calculate a net present value. So that's where those interest rates come into play. They look at that, calculate the net present value in order to determine how much they have to pay you right now for you to essentially try and go out there and recreate that same paycheck or that same annuity. But what happens is you take that lump sum, it gives you that flexibility to control those assets, whether you want to try and outperform that annuity, get your own annuity, maybe it has a better interest rate than what the company's paying, or God forbid you just want to go out and gamble it all away. You can. It's all your money. You have control over it, and that's the benefit of that lump sum. But with that control, you add risk, obviously. So a quick example, kind of interest rates as far as the lump sum, a quick kind of comparison maybe to a mortgage, so it's easier to understand. In this example, let's assume an annuity lump sum versus a mortgage, kind of one and the same. And let's assume that the annuity that somebody was getting was $1,950, or maybe the max they could afford on a loan right now for a house was $1,950. And let's assume the interest rate right now is 4%. So what that's going to mean is that's going to give them a lump sum of $408,000, or they could buy a house for about $408,000. Let's assume interest rates come back down in the future. Maybe that 4% now goes down to 3%. That means they can actually afford something a little bit higher, $462,000, or the company has to give them a higher lump sum of $462 because interest rates are lower, and it's going to take that much more money to try and create that same $1,950 paycheck on a monthly basis. So think about it like a mortgage. Lower interest rates, you can afford a bigger house or a larger mortgage. It's going to give you a larger lump sum as well. When interest rates go up, it's going to cost you in the fact you're not going to be able to borrow as much or get as high of a lump sum there as well. So I talked about a lot of this, but really the best way to kind of tie this together is on a one-on-one basis, because again, this is a generic discussion on pension lump sums and annuities. Really the best way is to look at your specific company plan, because we deal with a lot of different companies. But the best way to do it is to run a cash flow analysis. Right now, about 3/4 of Americans over 50 don't even have a written plan. If you can spend about 10 minutes with us gathering some data, different items like your 401k numbers, your pension options, we can run the Social Security estimate, what your budget is, what you're trying to solve for, what do you think you need to spend in retirement. We'll get all that information, put together a detailed cash flow analysis, and then set some time to sit down with you and go over it to let you know exactly where you stand. And then we can run those side by side to show you, okay, different retirement years, or if I retire, let's say at 60, versus take the pension as a lump sum versus an annuity. We can look at those side by side, how they play out in 10, 20, 30 years down the road, so you have a better idea of what your actual options are and help you make the best decision for you and your family going forward. So with that, I'm going to wrap it up. I see we've got a few questions coming through, so let's kind of get to some of those. But if you have any questions after the fact, feel free to call us at 800-900-5867. You can also reach us at info@theretirementgroup.com. You can email us there with a question or to set an appointment. There's a couple QR codes up on the screen. One's to get into our appointments if you want to schedule an appointment with myself or one of the other advisors. Go ahead and use that. It is going to give you access to our counter about a week out, so if you need something sooner, just give us a call. and there's one for the LinkedIn page, so you can follow along on our LinkedIn page or our specific LinkedIn page for your company, so you can stay updated on interest rate changes we mentioned for the lump sums or any company specific plan changes as well. So let me go ahead and cover some of these questions here, and then we'll let you guys go. First one, if my health is good, would the annuity be better since I would likely live longer? Okay, I kind of alluded to this, talking about longevity playing an issue with that annuity, and I'll go back to that $3,000 example because it's simple. But if you had longevity on your side and you've got parents in their 90s and relatives in their 90s and you think you're going to live a long time, obviously the longer you live, the more that annuity is going to pay out, because again, it's paid out for life. Whether you live to 75 or 95 or 105, it's going to pay out for your life. What's not going to change though is that cost of living is not going to be on there. So that 3,000 is going to obviously keep coming to you through age 100 or so if you live that long. But the purchasing power of it is going to erode over time. But generally speaking, if you've got longevity, you want simplicity, you want that steady paycheck, then yes, that's going to potentially make more sense. But it's always good to review based upon the interest rates. Maybe if we looked at a year or so ago, the interest rates were lower, it paid out a higher lump sum, so you had more beneficial options on there. But now going forward with higher interest rates, that annuity may still be more attractive. But there's also options of taking your own lump sum and buy your own annuity, which may pay a higher interest rate or may pay a higher rate of return for you. So a lot of things go into it, but generally speaking, longevity is a key concern. If you know you don't have longevity on your side and you might only make it to your 70s or something, there's no reason to take the annuity if you have the lump sum option, because you're probably more concerned about either protecting your family or maximizing your spending while you are alive. So those are some things to look at. Is it possible to take both, a partial lump sum and an annuity? Yes and no, maybe so. It just depends. Like I said before, this is a general webinar. Every company is different on what their options are. There are a few we work with that do give you the split option. Not many though, but some will give the option to split it up on a 25% interval. So let's say, for instance, you want to take half annuity, half lump sum, or maybe 75% annuity, 25% lump sum, or vice versa. We can go through all those different options with you, but that's, like I said, give us a call. We can let you know your specific company plans and make that a little bit easier for you to review and show you those choices and what those options are. Now, could you do this on your own? Yes, but you're not going to necessarily be able to take the annuity through the company if you don't have that option of a split strategy. What would happen is you could actually take the lump sum and then go out there and say, okay, let's say my lump sum is $800,000, and say I don't need, or excuse me, let's just say the annuity is going to pay you $3,000 a month, and but you don't necessarily need that because you look at Social Security and other assets. Maybe you only need $1,500 a month, and maybe your lump sum is $800,000, for instance. You might say, okay, well, let me take that $800,000 and maybe annuitize a portion of it. Maybe I only need to make an annuity out of $400,000 or $500,000 of it to guarantee that $1,500 or $2,000 that I need. And then that way I've got more flexibility with the other portion of that to invest it and do what I want on my own, or work with a firm like the retirement group. So that's another option where you can potentially kind of split it, but we have to kind of walk you through that and go through the pros and cons associated with that as well. If I don't take the company annuity, if I don't take the company annuity and I buy my own annuity, is there a benefit? Okay, so this kind of piggybacks what I was just kind of talking about a little bit. Yes, you can, and that's going to depend upon where interest rates are. This is something that we probably wouldn't have recommended the last 5, 6, 7, 8 years or so, because interest rates were so low. You got a better payment out of your company plan. That's changed over this last year, kind of really, kind of in the, I'd say in the summer of 2022, once the interest rates start catching up, and so far in 2023 as well. The interest rates have gone up so much that it's actually increased the payouts on private annuities. When I say private annuities, I mean like if you want to take an annuity from Nationwide or Allianz or Prudential or all these different insurance companies that are high caliber companies will pay you an annuity just like the company would do. And in reality, a lot of times these companies eventually turn over the annuities to companies like Prudential to manage them. So at the end of the day, you may have I'm just going to make up numbers here, but you may have a $500,000 lump sum versus maybe an $1,800 or let's say $2,000 lifetime annuity. Whereas if you in the past looked at it and said, oh, I want to take that $500, buy my own annuity, maybe it only got you $1,800 instead of $2,000. So it didn't get you as much. It may get you more flexibility because you have the option to potentially leave that to your beneficiaries more so than what you do from a company plan, or if you want to tap into it, you do, or if you want to invest it, there may be some options there. But maybe now, instead of that $2,000 company plan versus maybe $1,800 on your own, it might be you take that same $500,000 and maybe you can get $2,200 or $2,300 a month. So you actually get a better annuity outside of the company plan. Last year we were seeing a lot of these come out, 3, 4, 500, even some cases $1,000 more per month for life for an individual or for a joint and survivor annuity over and above what the company plan was paying. So it's definitely something to look at. And it goes back to that thing I just said before. You may not want to take that full lump sum and annuitize everything, maybe just a portion of what you need, or you can ladder that and look at other options as well. So that gives you the ability to get the annuity, but also have some flexibility with it as well, especially if you haven't saved up too much in the 401k plan. Okay, if I decide the lump sum is better for me, do I need a certain kind of financial advisor to help me manage it? Is it a CPA or better? Okay, so a CPA is a certified public accountant. That's going to be more in line with your taxes. Somebody that's going to be doing your taxes for you. A lot of CPAs have kind of gotten into the business of management. I don't know, even if they're the best of the best, I don't know if I would go that route because first part of the year, the first quarter or so, and then also during the fall when businesses are doing their taxes, it might be hard to get him or her on the phone. They're going to be busy doing taxes. So you typically want to look at something different. You want to look at a financial advisory firm if you're not going to do things on your own. And you want to definitely look at a firm or an investment advisory firm that has fiduciaries. That's very important. The retirement group, we've been fiduciaries for a long time before it became popular and before it became somewhat required. But a fiduciary is there to act in your best interest every step of the way, not just a broker who has to kind of look at things and act in your best interest when at the point of sell, when they sell you something versus provide it for you. Usually what happens is they can get you into some investments and do their job and then wipe their hands clean. They don't have to worry about it. Same thing with the insurance agent, especially if somebody's talking to you about annuities. Be extremely careful about that because I might be able to look at 100 different annuities and tell you there's only 2 or 3 that make sense for you. Whereas a lot of insurance agents may just have the 2 or 3 they like and they push that in and make that fit for everybody. So be very careful about that. So again, a fiduciary is responsible for doing what's in the best interest of you every step of the way, not just now, but throughout your retirement and helping you manage those accounts, and then making sure that they do it responsibly for you and your beneficiaries, because we are liable if we mismanage it. Maybe if we don't keep track of what your risk tolerance is or your time frame and make mistakes there, beneficiaries can come back and actually sue us. So you want to look for an independent investment advisory firm that is not tied to any specific company investment strategies, and make sure they are fiduciaries. That's the key thing in looking at that. Is my pension insured? Okay, yes and no. It kind of depends. So if your pension from your company, it's essentially self-insured by that company and the claiming ability of them. So that's one concern a lot of people have. If you go back and look at 2000 when a lot of the Delta pilots lost their pension, they didn't lose all of it because there was insurance on it, but those are limitations. So what happens is, let's say unfortunately something happens and your company goes under, they can't continue to make those payments, then the PBGC steps in and covers you up to a point. So that's one thing to keep in mind. If you've got a very large pension, it may not be fully insured. If you've got a smaller pension, chances are you're probably okay on that. But right now, I have to go back and look at the real numbers, but it's based upon different ages, the amount that's insured, and those numbers would come up with inflation. But if you're 60 years old, it's going to be close, I think maybe $3,500 or $3,800 a month is insured. So if you have a $3,000 pension, and you're 60 and the company goes under, then you're still going to get that $3,000 a month pension because it's under the PBGC. If you're 65, I think it goes up over $4,800 and maybe closer to $5,000 or so. So if you have concerns about that, let us know. We can look at it for you. But the worst case scenario would be, let's say somebody who's 60 and maybe gets a $5,500 a month pension and the insurance is only $4,000. So if the company goes under, now their $5,500 a month gets dropped to $4,000. So then that $1,500 a month is lost. So it's really important to kind of understand that. And then again, if you look at private annuities, then there's the insurance associated with that as well, between the insurance company and then also state guarantees back you at different levels as well. Okay, last one. We'll get this wrapped up for everybody and get you on your way. If I take an annuity, is there a risk of running out of money? So it depends. I mean, there's not necessarily a risk of running out of money per se. If we go back to that first question about the annuity and that example I gave you, you get $3,000 a month for the rest of your life. Whether you live to 75 or 85 or 95 or 105, you're going to keep getting that. So that money's not going to run out, assuming that company is still there to pay or PBGC has stepped in and is paying you. that money's not going to run out. The purchasing power of it will run out, not run out, but will dwindle. So again, let's look at, I mean, if you look at how much it cost to get gas just a couple years ago, or buy a hamburger. Obviously, we fast forward 10, 15, 20, 30 years down the road. $1,000 a month is not going to cover the same as it once had. So it's really important to understand that. And so again, the purchasing power is what could potentially run out. If you didn't take a life annuity, maybe you for some reason did a period certain and just had it set for 20 years, then yeah, after 20 years, then it's going to run out for you. But generally speaking, for most of these company plans, it's going to be paid out for life for you. But again, it's important to understand if you're looking at a spousal continuation or a joint survivor, if you're trying to make sure you take care of your family, that's really important to understand too, because a lot of these are not going to provide for anybody beyond your spouse or significant other. So if you want to make sure you're protecting your kids or a trust or something like that, that's where it might make sense to look at the lump sum and do something on your own or work with us to kind of structure something better for you. So there's a lot of great questions and a lot of questions. So let's go ahead and wrap this up. I want to thank everybody for joining us. Again, a quick reminder, even though we didn't go into company specifics, we do work with a lot of different specific companies. That does not mean we're employed by them nor endorsed by them, but chances are we've got a deep understanding of it. We can walk you through the whole process, make sure you don't make any mistakes and understand this as you transition. But if you have any questions, always reach out to us at info@retirementgroup.com or call us at 800-900-5867. I want to thank everybody, and we hope you have a great day.